Welcome to Accounting Principles 1E, the expanded accounting equation with example transactions. The prior videos we reviewed the accounting equation, some sample transactions, and then created a balance sheet. In this video, we extend the accounting equation to account for revenues, expenses, and withdrawals. Let's define what these are. A company earns revenue when it provides services to its customers. When revenue is earned, owner's equity is increased. Thus, revenue is a subset of owner's equity. When revenue is performed, assets are also increased. Assets can increase as either a form of cash if you collect the money from the customer, or a form of accounts receivable. Accounts receivable accounts for the money that you have not yet received, as maybe the customer promises to pay you in the future. So again, when revenue is earned, transactions are recorded as an increase in revenue and an increase in assets, either as cash or accounts receivable. Expenses are the costs a company incurs while aiming to produce a revenue. Expenses are also a subset of owner's equity. When expenses are incurred, they decrease owner's equity. Also, when expenses are incurred, they will either reduce cash if paying with cash, or increase the liability account of accounts payable if you're going to pay in the future. Withdrawals is also a subset of owner's equity and accounts for if the owner of the company wants to withdraw cash or other assets from the business and use them for personal use. Withdrawals decrease owner's equity. So let's look at these three new accounts and how they relate to owner's equity. Remember from our prior videos, the capital account is for the personal investment the owner makes into the business. This increases equity. Revenues increase equity and accounts for services performed for customers. Expenses decrease equity and are incurred by the business while trying to make revenue. Withdrawals decrease equity as they account for assets the owner takes back out of the business for personal use. Let's say, for example, I had $10,000 in capital, $5,000 in revenue, $3,000 in expenses, and $1,000 in owner withdrawals. How much equity would I have? Well, I would take $10,000 plus $5,000 minus $3,000 and minus $1,000 to get a total equity balance of $11,000. Note, it is important to understand there are also two types of accounting systems, a cash basis and accrual basis. A cash basis accounts for revenues when cash is received, and expenses are recorded when cash is paid. The accrual basis accounts for revenue when the services are performed or earned, whether the customer provided you cash or not. In our examples, we will be using the accrual basis, which is most common in organizations, and account for revenue and expenses as they are earned or purchased, and we accrue for uncollected money from customers and accounts receivable, and unpaid expenses or purchases using accounts payable. So let's look at some transactions and their impact to the accounting equation. We will start with balances based on where we left off from the prior videos, with $3,000 in cash, $16,500 in equipment, $4,500 in liabilities, and $15,000 in capital or equity. I will add in the four new titles of accounts receivable, which again accounts for cash owed to the company from customers, revenue, expenses, and withdrawals. Notice how the equation calculates to make the accounting equation balance, where asset accounts are added together to get total assets. Then add liabilities to capital, add revenue, subtract expenses, and subtract withdrawals to get total liabilities and owner's equity. So let's look at transaction 5. I provide services for cash of $7,000. Let's analyze this. Because we are collecting cash, we will increase the cash account by $7,000. Because we are providing services, we increase the revenue account by $7,000. We then determine our new totals. Thus now we have $10,000 in cash. We carry down our balance of $16,500 for equipment, $4,500 of accounts payable, $15,000 of capital, and then our revenue total of $7,000. We also do a quick check to verify the accounting equation balances. Here, assets total $26,500, and liabilities and owner's equity also totals $26,500. Thus, the accounting equation balances. Moving on to transaction 6. We provide services on account for $2,000. So let's analyze this. I provided services on account, so I did not receive cash. So what accounts are impacted? Well, provided services tells me I need to increase revenue by $2,000. On account tells me I didn't yet collect cash from the customer, but cash or an asset is owed to me. Thus, I would put that value into accounts receivable. Remember, when you are owed money, it is an asset and goes to accounts receivable. When you owe a creditor or someone else money, it is a liability and goes into accounts payable. Let's add our totals as shown on the screen. Thus, I still have $10,000 in cash. I now have $2,000 in accounts receivable. $16,500 remains in equipment. $4,500 remains in accounts payable. $15,000 remains in capital. And my new revenue total is $9,000. Again, you should check your accounting equation that it balances. And it does, with assets having $28,500 and liabilities and equity having $28,500 as well. Let's look at transaction 7. Your customer from the last transaction came to you and paid half of what they owed, which is $1,000. So, let's analyze that. The customer paid you, so you received cash. Thus, I know I'm going to increase my cash for $1,000. But what other account do I need to impact? It would not be revenue, as I did not perform services again, nor would I want to account for the same revenue twice. But instead, it would be reducing the amount they owe me, thus reducing accounts receivable. So I will do a $1,000 reduction to the accounts receivable balance. Thus, I am just doing a shift in assets. Again, I will compute my balances and confirm the accounting equation still balances. Moving on to transaction 8. The company pays $3,000 of salaries. So I pay salaries, which is going to reduce cash by $3,000. Salaries is an expense, so I'm going to increase the value of my expenses by $3,000. This may be confusing, but remember, owner's equity decreases as expenses increase. So we will retotal our accounts and notice how the accounting equation is still in balance. Assets, I have $25,500. Then I take $4,500 of liabilities and add $15,000 of capital, add $9,000 in revenue, and subtract $3,000 of expenses to get the total of $25,500 of liabilities and owner's equity. Let's look at transaction 9. The company pays rent expense of $500. So again, if we analyze it, we pay rent, and are going to reduce cash by $500. Rent is an expense, so I will increase the total amount of expenses the company incurred. Thus now my cash account balances to $7,500 and expenses increase to $3,500. Again, as a check, we balance the accounting equation. Total assets equals $25,000, and if we take the liabilities of $4,500 and we add capital of $15,000 and add revenue of $9,000, subtract expenses of $3,500, we'll get $25,000. Thus, the accounting equation balances. For transaction 10, we incurred advertising expenses of $1,500, which will be paid next month. So I incurred an expense. Thus, I'm going to increase the amount of expenses I have by $1,500. Now, I didn't pay with cash, but instead I'm going to pay for the expense in the future. So what does that mean? It means I have a liability. Thus, I would increase the liability of accounts payable by $1,500. Next, I will recheck my accounting equation to ensure it still balances, which it does, with $25,000 in assets and $25,000 in liabilities and equity. Note, when I do decide to pay for this later, I would reduce cash and reduce accounts payable at the time of paying. Let's look at one final transaction. Let's say I withdrew $100 for personal use. If you remember from earlier in the video, when I take money for personal use, I would categorize that as an owner's withdrawal. Thus, if we go to our equation, I reduce cash by $100 and I add $100 to my withdrawal account. I retotal my accounts and balance the accounting equation. Here I have a total of $24,900 in assets. Then I have liabilities of $6,000 plus capital of $15,000 plus revenues of $9,000, then subtract expenses of $5,000 and subtract withdrawals of $100 to confirm my total liabilities and equity equals $24,900. This concludes video 1E. Join me in the next video to review how to map these totals into the three financial statements: the income statement, statement of owner's equity, and the balance sheet.